Morning. I'm glad everybody's able to come. For those of you who are just joining us for the first time, we're going to go through our economist board. I'm John. I've got Keith and Chris from Armada here. I'm from Morris Nelson and Associates. We're going to go through our economist board, which is our monthly review of all the content that we pull out of the models and see what makes sense and see if we can explain what's in front of us. So I'm going to go ahead and share my screen. And Keith, Chris, jump in as soon as you see something that looks crazy. Clearly not on the first slide. We'll jump right into the model for industrial production for manufacturing. If you can take a look at that right now, you can see our July forecast was a little flatter. The August forecast a little flatter in terms of the appearance of it. You got a little bit more of a swing now towards like the beginning of first quarter of 02, and it wavers. It doesn't get up above. In fact, it's a little depressed over the time. It doesn't quite hit 100, whereas before we were kind of floating in between that 100 to 105 range for several months. No major changes in what went into the model. Just as I think the supply chain matured, we were starting to see some of those things appear in the model inputs. I'll turn over to you guys for that.
Yeah, John, just real quick. So 100, what is the Federal Reserve now using for their base year? Is this 2017?
It was 2017, I think, was the base year.
So anything over 100 means that we're benchmarking against the base 2017 year. So, okay. So we're now trending below
we should levels. I can tell you that real quick. So our base year should appear right here.
Yeah.
So yeah, right there, there's our base right there at a 12/1/2017 or right in there.
Okay.
So there's our long range look. I'll go back to the current month.
Yeah, and the data that we're seeing matches up with a lot of the other stuff that's out there these days. We were on a pretty good tear for a while. If people go back to June and May, and even before that, we were in a very, very accelerated pace, but that's been slowing down. And it's been slowing down for all the reasons that we're all depressingly familiar with now. I mean, we've got the supply chain interruptions, we have the kind of the resurgence of the pandemic and the partial shutdowns that are affecting more internationally at this point than the US, but it's percolating into the US economy as well.
It's kind of interesting. I mean, we're using 18 to 20 different economic metrics to build these models. We're not influencing what we're seeing here. This is all analytics and methodologies in the models. So it is interesting that the models are now picking up some of exactly what Chris just said, some of those supply chain challenges, chip shortages, just a lot of different things kind of going on. But in general, this is a lot more weakening than I think what most forecasters are thinking about. So it's interesting that the data is starting to pick it up. And I think, John, we would normally mention too that there's a cone there. So there is an upside to the forecast that looks a lot more optimistic, that would really start to take it into some pretty high ranges in 2022. So, and then the reverse is also possible. But so
well,
John,
that's interesting that you mentioned the cone, Keith, because as we've seen over the last couple months, the forecast changes every month a little bit as the new data comes in, and you get a little bit of this kind of whipping effect. So month to month, the end of the curve kind of whips a little bit. But if you take that analogy of the whip, if you look where it was last month, the last month's forecast was within this cone of variability. It's sort of like forecasting a hurricane. Where's it going to hit? Well, we don't know. It's somewhere in this big swath.
Yeah. So a lot of folks always write in, and I'm going to probably aim this at Chris a little bit. They write in and they want to know what to do with this data. And I know that we have a lot of different types of subscribers to our forecasting model. So financial analysts, we know that manufacturers are watching this data. We also know suppliers and raw material producers are watching this data. I mean, Chris, if there is a headline or a big takeaway for those individuals, I mean, what would we start to tell them here?
Yeah, I think the thing that people have to recognize is data is only useful if you can act on it. And stuff that's coming right up, stuff that's coming in September and October, there's not a whole lot you can do. I mean, you've already made the decisions, you've already got your structure in place, so you can't react fast enough. So a manufacturer, by definition, is going to be looking 6 months, 9 months down the road. So whenever you're looking at this data, you are kind of looking at the end of it, saying, okay, it's really too late for me to do anything to react to this little downturn that we're going to get at the end of this year, beginning of next. However, I can react to what I'm seeing at the other end of this chart. I can start being prepared for mid 2022. So what do I need to do? If I'm looking at the downturn that's coming up in the immediate future, well, my tendency is to panic and say, oh my God, we're getting back to where we were and things are looking bad. But then you look out a little bit ahead, say, okay, I'm not going to react to this, because it's beginning to drift back up by the time we get to the end of next year. That I can prepare for. So I think the takeaway for all of this stuff is really paying attention to the forecasty part. We can tell you where you are. I mean, the old joke is economists are really great at predicting the past. We're trying to get ahead of the game and say, look, don't be too alarmed by what you see in the next quarter or two, recognizing that you can't really do a whole lot about that anyway. So you're looking at third, fourth quarter down the road.
Well,
The
and
other
when
thing I wanted to mention about, though, you talked about the downturn, Chris, is remember the scale
Yeah,
that we're looking at. It looks like a big curve, but the bottom, the total scale here, which includes the very bottom of the worst time that we had 18 months ago, that's 80.
yeah,
Well,
exactly.
so this whole dip that we're talking about is only 3 or 4 points on the index. So just a
Exactly.
few percentage points. It's not a big drop. If you were to put this from 0 to 110, that would be my scale. It almost looked like a flat line.
Exactly.
One of the things that's also interesting. So this morning we were watching all the PMIs coming up from all around the world, and there is this notion of kind of a little bit of a shift happening. And I know, Chris, you and I have talked about this a number of times, but we're coming off of a peak. We know we are. We know we're coming off of some outrageous data from May, June, in that time period where manufacturing was robust, commodities were at peak prices. And so just in the PMIs this particular month, as I read through them this morning, I started to see a noticeable change in a few areas around the world. So there are sourcing managers that are now starting to pull back on ordering of commodities and a lot of components that have escalated in price. So manufacturers were starting to see some buildup of finished goods, like especially in Brazil and some of the countries that aren't really on the mainstream for global manufacturing, if you will. We're starting to see some of those inventories start to climb, whereas there's some areas like in China where they can't get enough products, cranked off of docks to be able to fulfill orders. So new order growth is not growing at the same pace we saw a couple of months ago. And so we're now starting to hear a little bit about this manufacturing squeeze where inbound input prices are so high and some of the outbound demand is starting to soften a little bit on a global perspective and starting to squeeze profits. And we just started to see some of that start to occur in the latest August data.
Yep. And the other thing that we've been watching all summer, and we've talked about this before, is the polite word for it has been stockpiling. The impolite word has been hoarding. People were concerned about supply chain. They didn't know if they were going to be able to get things. They were watching inflation, so they were buying more than they needed. They wanted to make sure they weren't going to get caught short. Well, you come to a point where it's like, okay, I cannot buy anymore. Either I don't have the ability to, or I'm really worrying that I'll be able to use that inventory later. And all of a sudden, you're seeing this decline in purchasing, which is rippling through the whole manufacturing sector. I mean, yesterday I was meeting with a whole bunch of manufacturing support people from all over the country, and all of them were reporting basically the same thing, that companies had done a lot of advanced purchasing and were now calling a halt. and saying, look, I don't want to get stuck with all this inventory next year if that demand flattens, as you mentioned, it started to show.
Well, let me ask you, I got two questions. The first is, I read a report the other day. It talked about ships being stacked up like cordwood outside the port of California, port of
Long
Long
Beach and
Beach
LA.
and LA. And it was a 44 container ships,
Right.
which is more than the height that we experienced one time before. And the speculation was, well, not only things are catching up, but now people were starting to order for Christmas.
Mm-hmm.
What kind of effect do you think that's going to have over the next few months on what we're looking at?
Maybe let me take this one for a second at first. So it's important to know there are 3 different types of countries around the world as it comes to COVID. So the first is a country like China, and there's only a couple of them around the world where they have a 0 case policy. So if what we had like in the port of Yantian and the port of Ningbo is we literally had a few dock workers, just a couple, that tested positive for the Delta variant of COVID. And so they ended up shutting down those entire terminals. So that's why we had complete closures of an air cargo terminal in Shanghai. Again, the closure of the port of Yantian, and then the 4th largest port in the world, closure of the port of Ningbo. So that's one type of country. The other type of country is what we see kind of in Southeast Asia, where vaccination rates are down below 5%. And so COVID literally is just running rampant through the population. Hospitals are overwhelmed, and you have companies that literally are shutting down because they don't have enough people showing up for work. The port of Ho Chi Minh was exactly that scenario, where it wasn't just even, crane operators and port operators, but the warehouses that just sit just off of those ports, they didn't have enough workers show up for work to be able to open. So you've got major disruptions there. The third type of country is what we see like in the US and now in the UK, where, hey, the virus is here, we're still part of a pandemic, but we're kind of just gutting through it. And if you're sick and you're extremely sick, you go to the hospital. If you're not, you kind of go on with your business. And so there is still a little bit of a pullback, but it's just not as dramatic. So those port disruptions, you're right, off the coast of Shanghai and Ningbo, there's over 140 ships anchored waiting to get unloaded. And they're saying that a lot of those component parts and a lot of those products are probably going to miss at least the front end of the Christmas season. Off the LA Basin ports, like you guys were talking about, there was about 40 at anchor, and starting to process through that cargo. But the problem is all of these products, all of this is coming in waves. So we'll go through a little bit of a lull period where the supply chain can catch up, and then all of a sudden it just gets hammered by this influx and this inbound wave of component parts and products and finished goods.
Yeah, and one thing to add to that is China's discussion about its no tolerance policy. The reports that are coming out of China saying, yeah, they're telling you it's 1, it's not, it's thousands. China is continuing to lie through its teeth and basically saying, oh, we don't have this problem. Yes, you do. And honestly, if you think we believe you that you're going to shut down your 3rd largest port because one guy has COVID, we know that it's more than that. And we're getting the reports in from the companies saying, well, I don't know which guy they're counting, but, we're missing about 1/3 of our workforce. So that's the issue, is that we still don't have good data as to where the situation stands. And the end result is that we just have supply chain confusion, which is going to last a long time. I mean, it's not going to dissipate in the next month or two, probably in the next quarter or two.
So I got one more question before we jump on to taking a look at the long range and the year over year. If you look at where we're sitting right now, we're right here at around that 100 mark. And if you look back at January of 2000, we were just short of the 100 mark. That was the time then you guys were saying, if you aren't ready for COVID, you better get ready now or you're already too late. And sure enough, a month later, the bottom fell out. Well, we got the rise in the Delta variant, although we've been dealing with it, but you still have hospitalizations are getting to where they were at the peak of the variant of the alpha variant wave. And now we have the new variant that looks like it could be of interest as well. What do you think? I'm going to ask you to look into your crystal ball way away from the mathematics. Do you think we're going to see any kind of major impact different, or have we had the mechanisms in place to deal with it this time?
Well, the critical difference, I think, and we've really almost got to separate the whole COVID crisis into two halves. We had the pandemic itself, which is dangerous in and of itself, people not able to go to work and rampant illness. But what really sent the economy into the recession was the lockdown. That the response to COVID was haphazard and confused. We didn't know how long it was going to last. The assumption was it was going to be over by May or June, and the lockdown was only supposed to last a month or two. And of course, it lasted over a year and a half. What you're not hearing now is that lockdown conversation. You're not hearing the United States or Europe saying, okay, our solution to this is to shut every service business down, put 50 million people out of work, destroy another 900,000 businesses. So now it's will the consumer continue to go back to their normal routine? Some will, some won't. Are there still going to be issues as to where people work remotely, et cetera? Yes, but I don't think you're going to deal with that lockdown, which would prohibit that steep decline. We're still going to get a reaction to it, but it was the lockdown that sent us into recession.
Yeah, I would only add to that there's a lot of companies like construction firms that we talk to, and just listening to them, there's a lot of projects out there that companies would like to go ahead and initiate, but because of Delta, they're just kind of putting them on hold. So some of them have even gone through the design phase, they've even gone through the planning phase, but before they start putting shovels in the ground, they're just pausing for a little bit. Some of it's because something as simple as I can't get a steel truss. We talked to one construction company, and they have a back order on steel trusses that go like in the roofs of warehouses, and they're stretched out over a year. So they can't even start a project until sometime, late in 2022, just because of component shortages. But Delta alone, especially like in the healthcare industry right now, where you can't even think about creating a construction site where you've got people coming through that are sick with COVID itself. And so you just see a lot of hospital administrators in some industries where they've just pulled back from even starting projects. And we're still just waiting on that moment where they start to pull the trigger. I mean, money's available, interest rates are low. All of the normal factors that would drive like construction activity are all in place. They just, Delta just kind of put some of those plans on hold. So.
Sure. All right, well, let's take a look at the long range. If one thing to note is overall, you have that general slope increasing over time. The overall manufacturing outlook, that's our trend line here across the center in the dotted where things are. And you can see we're not too far off of the major trend line. Of course, you have the ridiculous drop here, but this kind of gives you a little bit, maybe a better understanding, at least in my view, of, well, just how bad have these swings been? Are they that unprecedented? Well, yeah, it's a pretty good swing here, but when I look back at some of these other swings that we've seen in the past, it's not outlandish.
Right.
What's your thoughts?
Well, the only issue there is those were recessionary dips.
Yeah. Well, and I think the important thing that I have pointed out to people repeatedly is looking at the recession in 2008 versus the one we just went through. The 2008 recession in many ways was worse because it took forever to recover from. We never really did get back to where we were in 2007. This one so far has been a V-shaped recession with a bit of a W thrown in terms of what we're predicting next year, but not a serious one. So the V-shaped recovery is the preferable one. It's kind of short, sharp, intense, and then you get to move on. So I think we're at least not heading, I don't think, towards another one of those check mark, very, very slow recoveries. When we do come back, it's going to be fairly swift. It was coming back from this initial recession because people were anxious to get back to their old lives. that's been suspended temporarily, and we'll just have to see what happens from here.
Well, and Chris, just thoughts on this, but this dip that the forecast or the model is picking up isn't really demand related, right?
No.
This is all supply constraint related,
Yep.
which you go back in history. I don't know. Do you remember when the last time was we had a major supply constraint driven downturn like this?
And that was in the 80s, and that was one that was prompted by inflation. You know, the fact that you had a dip in supply because prices got so high that it was interfering with the supply chain, and that's what provoked Volcker's, radical interest rate routine, the whole 9 yards. So that again was almost more of a government imposed reaction, even though then it was almost entirely by the Fed. But you're right, it's relatively rare. The demand drop is what we got in 2008, and that takes a lot longer to come back from.
Yeah. So there's some speculation that supply chains start to get back in cycle sometime early next year. And that would start to smooth this out, but the model's picking that up. So, well, I guess a little bit, but it's starting to see a little bit of that recovery kind of by mid-year next year. I just saw, and I forget which country it was. I believe it was either Brazil or it was Germany. It's actually Germany. The manufacturing report, in their survey, they noted that most manufacturers in Germany were saying that they felt like the global supply chain backlogs that we see today would be, quote, normalized by May of next year. So it's interesting. Again, we don't influence these models. It's all data driven. And it's a little bit of what the model is kind of picking up is that recovery. So it's interesting.
Yep, and you've got all the necessary factors. The Europeans are also hitting inflation rates they've not seen in over a decade, and that's also been prompted by the supply chain mess. I mean, the Germans are highly sensitive to inflation. They have not seen rates like this in over 20 years, and that provokes them to do a lot of things, which in some respects helps with supply, because frankly, getting the supply chain back in shape also means reducing a little bit of the pressure on it. And when inflation becomes an issue, well, people start buying less, and it's just, you're seeing that with lots of sectors. We're going to talk about some of the sectors in a minute, but like aerospace, how are the airlines responding to this lack of supply? They're cutting back. They're reducing flights. They're grounding planes. They're trying to control demand, which is one of the ways you either beef up your supplying or you reduce the number of people that want what you're selling. So,
yeah. Right, exactly.
All right, so here's our year over year. Just to kind of orient everybody to the chart, 2021 is here in the red, and the dashed show you the forecast towards the end of the year. The other years of note, of course, here's 2020. Goes off the chart here at the bottom in the dip. And we did include at the back end here, October, November, December of each previous year, just so you could see where the trend line of the current year was coming in.
now on the 2020 data, John, I thought you were going to put a box in there that said "Here be dragons."
Yeah, here be dragons. That's right. Absolutely. I'm not. The only thing I'm seeing, from my side is I see a little bit of this curve right here. It kind of reminds me a little bit of this curve here in 2018, a little bit, that hump there, but it's probably not, not a real similar situation, but otherwise, I mean, it's not out of range of everything. It seems to be trending right there in the middle.
Yeah, I know the three of us kind of fight about this chart once in a while. It's kind of fun, brothers in arms and, fighting over everything. But this is one of my favorite charts. And one of the reasons why is for a lot of management teams, what I like to do is I like to look at it and I like to know that, okay, this year is trending a little bit like 2015. So if I can go back and look at a playbook and I wanted to know what that playbook, what we did, what was successful, what was not successful, I'd at least know kind of what years to start looking at when it comes to, just trying to understand, how we operated, how we were staffed, what kinds of inputs we did, any changes that we may have made going into the end of the year. And so it just gives you an idea, just sort of something to relate it to that you have as common knowledge. And so the only thing we don't show on this is the upper end or the lower end of the range, which would be interesting because I can guarantee you that upper end, when I remember the index numbers, it would have made it trend toward the end of the year, or early, especially early in 2022, as one of the strongest years we've had. So again, it's one of the things, not a sales pitch, but one of the reasons why we decided to move this to monthly updates is that economic data gets updated monthly. And so as that new data flows in, we want to be able to see what it does to the out model 18 months in advance. Within the next month or two, we're confident that the model is telling you and showing you what's going to happen. I mean, John, for this particular model, we've been running what, 97, 98% accurate within a month
Yeah,
or
over
2 months out.
over the course of 3 months, we were pegging it out a little bit in between 96 and 97% accurate over a period of 3 months.
Yeah. And some of that are the weird things like microchip shortages and things that you just can't predict.
Yeah, and just following up on Keith's comment about how to look at this stuff historically, we all sort of fall into the pattern of daily crisis is the only crisis, and we sort of overreact to what's happening right now, and we forget what we've been through. And if you go back to those post 2008 recession years, there were some very rugged years that took a long time to recover from, and as a result, we tend to forget what we had to put up with. And I'm getting assistance from my cat here. So
That's awesome.
yeah, right. So we told you this was going to be informal, which involves Zoom bombing from animals when least expected.
Yeah.
But to Keith's point, going back to 2014, 2015, 2016, we're looking at years that were similarly stressful, but for different reasons. And we just have to recognize that a lot of what we're dealing with is not really unprecedented. It's something that we have had to deal with in the past, and we've had solutions and things that didn't work in the past. So it gives us an opportunity to go back to those and say, yeah, well, we tried that in 2014 and it was a disaster. So let's not do that again. So.
Well, all right, guys, I think we're close on time. So Keith, I probably think we ought to bring it to a close. Any closing comments and then to kill the recording?
Yeah, I would just tell everybody again, this is just one of what, John, 8 different sectors that we look at. So we cover everything from aerospace to automotive inside the ASIS, the Strategic Intelligence System. So what we're going to do is we're going to cover this one because it's the overall blend of all those subsectors, into one, major, model. But each of those independent subsectors look very different and they're performing very differently. So, if you're focused on aerospace, you definitely want to check out the aerospace model. If you're into fabricated metals or machinery or primary metals, you definitely want to look at those individual models. You can get a free trial. If you're not a subscriber, not a member, you can get a free trial, no obligation. We're not going to hound you. 60 days, test drive it. After 60 days, it just goes away if you do nothing. So all of those other models are going to be sitting behind the registration screen. So hope everyone enjoyed this. We'll get a little bit tighter and a little bit quicker in the future, so we don't take as much time out, but wanted to give you a good background on it.